I've spent 6 decades watching government promises, and I'll tell you something that might surprise you. The Social Security Administration just confirmed numbers that most Americans haven't fully grasped yet. February's payments are landing in bank accounts right now, and the mathematics behind what you're actually receiving deserves a closer look than what you're getting from the evening news. The cost of living adjustment for 2025 came in at 2.5%. Now, that sounds modest on the surface, but here's what the actuaries won't emphasize in their press releases. This adjustment, unlike temporary stimulus payments or one-time bonuses, compounds permanently into your baseline benefit. Every future COLA calculates from this new, higher amount. It's the power of incremental gains that most people overlook entirely. If you were receiving $1,900 monthly in December, you're now looking at $1,148 in February. That's $576 annually, and it stacks onto every subsequent increase for the rest of your life. The real question isn't whether this constitutes a raise in the traditional sense, it's whether you understand how to position yourself for what's coming next in the benefits landscape. Because 3 significant policy discussions are happening in Washington right now that could reshape your planning entirely. Let me walk you through what's actually happening with your money, because the devil, as they say, lives in the details. I've always believed that the quality of your decisions depends entirely on the quality of your understanding, and right now there's a tremendous gap between what people think they know about Social Security and what the numbers actually reveal. The 2.5% COLA that took effect in January represents something fundamentally different from what most financial commentators are discussing. When I look at Social Security adjustments, I don't just see a percentage increase. I see a recalibration of your guaranteed income stream for every remaining year of your life. This isn't a bonus that disappears next quarter. This is your new floor, your new baseline, and every future adjustment builds on top of this foundation. The mathematics of compounding don't just apply to investment portfolios. They apply to Social Security benefits with the same relentless logic. Now let's talk about what this means in actual dollars, because percentages can obscure reality. The average retiree benefit in December 2024 was approximately $1,127 per month. With the 2.5% adjustment, that climbed to $1,876 in January, and that's what you're seeing deposited this February. For couples where both spouses receive benefits, you're looking at an average household increase of roughly $98 monthly or $1,176 annually. These aren't hypothetical numbers. These are the actual figures landing in checking accounts across America right now. But here's where it gets interesting, and this is something I want you to think about carefully. The Social Security Administration bases these cost of living adjustments on the Consumer Price Index for urban wage earners and clerical workers, the CPIW, not the CPIE, which tracks expenses for the elderly. This distinction matters enormously because your spending patterns as a retiree differ substantially from those of working age wage earners. You spend proportionally more on health care, prescription drugs, and housing maintenance. You spend proportionally less on transportation, education, and professional clothing. The inflation you experience in your daily life may be running considerably higher than the inflation measured by the index used to calculate your adjustment. I've watched this discrepancy play out over decades, and it creates a slow erosion of purchasing power that most beneficiaries don't recognize until they're significantly behind. Medical care costs have been rising at roughly 4 to 5% annually over the past decade. Your COLA is 2.5%. The mathematics aren't complicated. Every year you fall a little further behind in your ability to cover healthcare expenses unless you're making adjustments elsewhere in your budget or finding additional income sources. Now let's address the payment schedule, because timing matters when you're managing monthly expenses. Social Security doesn't send everyone their payment on the same day. If you started receiving benefits before May 1997, or if you receive both Social Security and supplemental security income, your payment arrives on the 3rd of each month. For everyone else, the payment date depends on your birth date. If you were born between the 1st and the 10th of the month, you receive payment on the 2nd Wednesday. Born between the 11th and the 20th, you get paid on the 3rd Wednesday. Born between the 21st and the end of the month, and you're looking at the 4th Wednesday. February 2025 breaks down like this. Payments for those on the third of the month schedule arrive February 3rd. Those born between the 1st and 10th receive payment on February 12th. Those born between the 11th and 20th got paid February 19th. And those born between the 21st and the end of the month receive payment February 26th. If your payment date falls on a weekend or federal holiday, the payment comes the preceding business day. These schedules have been remarkably consistent for years, and understanding them helps you plan your cash flow with precision. The question I hear most often is whether this increase is permanent, and the answer requires some nuance. Yes, the 2.5% increase is permanent in the sense that it becomes your new baseline benefit amount. It doesn't expire, it doesn't revert, but it's also not the last adjustment you'll see. Every October, the Social Security Administration announces the COLA for the following year, based on the percentage increase in the CPIW from the third quarter of the previous year to the third quarter of the current year. If inflation continues, you'll see another adjustment next January. If we experience deflation, which is rare but not impossible, benefits are protected by law and cannot decrease. This protection against reduction is one of Social Security's most valuable features, and it's worth understanding completely. Since automatic cost of living adjustments began in 1975, there have only been 3 years with zero COLA: 2010, 2011, and 2016. Even in those years, benefits didn't decrease. They simply remained flat. This floor protection means Social Security provides something increasingly rare in financial planning: a guaranteed income stream that can only stay the same or increase, never decrease, regardless of economic conditions. Let me shift now to something that's generating considerable discussion in policy circles, because what happens in Washington over the next several years could reshape Social Security in ways that affect your planning significantly. There are currently 3 major proposals receiving serious attention, and each would impact beneficiaries differently. The first proposal involves raising or eliminating the wage cap on Social Security taxes. Right now, only earnings up to $176,100 are subject to Social Security taxation. Every dollar you earn above that threshold is exempt. Some proposals suggest raising this cap to $250,000 or even eliminating it entirely, which would require high earners to pay Social Security taxes on all their income. The theory is that this would extend the solvency of the trust fund by decades without reducing anyone's benefits. If you're currently receiving benefits, this change wouldn't directly affect your payment amount, but it could prevent future benefit cuts that might otherwise become necessary. The second proposal focuses on adjusting the full retirement age. Right now, full retirement age is 66 for people born between 1943 and 1954, gradually increasing to 67 for those born in 1960 or later. Some proposals suggest raising it further to 68 or even 69 for younger workers. This wouldn't change your current benefits if you're already receiving them, but it would affect the claiming strategies available to younger family members and could influence survivor benefits down the line. The third proposal, and this one gets less attention but matters tremendously, involves switching from the CPIW to what's called a chain CPI for calculating cost of living adjustments. A chain CPI assumes that consumers substitute cheaper alternatives when prices rise, so it typically runs about 0.3 percentage points lower than the standard CPI. Over time, this seemingly small difference compounds dramatically. A benefit that would grow to $2,000 under current COLA calculations might only reach $1,950 after 20 years under a chain CPI. For someone in their 60s now, this could mean tens of thousands of dollars less over a lifetime. I want to be clear about something. None of these proposals have been enacted. They're being discussed, debated, and analyzed, but no legislation has passed. However, the Social Security Trust Fund faces a genuine solvency challenge. Current projections suggest that without changes, the trust fund reserves will be depleted by 2034. At that point, incoming payroll taxes would cover only about 79% of scheduled benefits. Something will need to change before then, either through revenue increases, benefit adjustments, or some combination of both. Understanding this timeline is crucial for your planning. If you're already receiving benefits, you're in a relatively protected position. Politically, it's extraordinarily difficult to reduce benefits for current retirees. The most likely scenarios involve changes that affect future beneficiaries or high-income current beneficiaries. But you should be prepared for the possibility of means testing, where benefits might be reduced for individuals with substantial income from other sources. Now, let's talk about maximizing what you're receiving, because there are strategies most beneficiaries never consider. If you're married and both spouses have work histories, the decision about when each spouse claims benefits can make an enormous difference in lifetime benefits. If one spouse earns significantly more than the other, it often makes sense for the higher earner to delay claiming until age 70, maximizing the survivor benefit. The lower earning spouse might claim earlier, providing income while the higher earner's benefit continues growing at 8% annually. This decision requires careful analysis of your specific situation, including your health, your financial needs, your life expectancy expectations, and your other income sources. I've seen couples leave hundreds of thousands of dollars on the table by claiming too early without understanding the mathematics of delayed retirement credits. Every year you delay claiming beyond full retirement age, up to age 70, your benefit increases by approximately 8%. That's an 8% guaranteed return in an environment where finding safe, guaranteed returns is increasingly difficult. For those of you who claimed early and are now receiving reduced benefits, there's a little-known provision that might be relevant. If you're within 12 months of your initial claim date, you can withdraw your application, repay all benefits received without interest, and reapply later for a higher benefit. After that 12-month window closes, you have one more opportunity. If you've reached full retirement age and are receiving a reduced benefit because you claimed early, you can suspend your benefits. They'll earn delayed retirement credits until age 70, increasing your monthly payment permanently. Taxes represent another area where understanding can save you substantial money. Up to 85% of your Social Security benefits may be taxable depending on your combined income, which the IRS defines as your adjusted gross income plus non-taxable interest plus half your Social Security benefits. If you're single and your combined income exceeds $34,000, or married filing jointly with combined income exceeding $44,000, up to 85% of your benefits become taxable. These thresholds haven't been adjusted for inflation since they were established in 1984, which means more beneficiaries face taxation on their benefits every year. Strategic withdrawal planning from retirement accounts can help minimize this tax burden. If you have both traditional IRAs and Roth IRAs, you can sometimes manage your taxable income by choosing which accounts to draw from in which years. Converting traditional IRA assets to Roth accounts in years when your income is lower can reduce required minimum distributions later, potentially keeping you below the thresholds where Social Security taxation increases. Let me address something else that causes tremendous confusion, the earnings test. If you're receiving Social Security benefits before reaching full retirement age and you're still working, your benefits may be reduced if you earn more than certain thresholds. For 2025, if you won't reach full retirement age this year, Social Security deducts $1 from your benefits for every $2 you earn above $23,400. In the year you reach full retirement age, the deduction drops to $1 for every $3 above $62,160, and it only applies to earnings before the month you reach full retirement age. Once you reach full retirement age, the earnings test disappears completely, and you can earn unlimited amounts without any reduction in benefits. Here's the crucial point most people miss. These reductions aren't permanent losses. When you reach full retirement age, Social Security recalculates your benefit to account for the months when benefits were reduced due to the earnings test. Your monthly payment increases to reflect those withheld benefits. It's not a dollar-for-dollar recovery, but it does mitigate much of the impact over time. Medicare premiums represent another consideration that directly affects your net Social Security payment. Most beneficiaries have their Medicare Part B premiums deducted automatically from their Social Security checks. The standard Part B premium for 2025 is $185 per month, but high-income beneficiaries pay more through income-related monthly adjustment amounts, or IRMAA. If your modified adjusted gross income from 2 years ago exceeded certain thresholds, you're paying additional premiums. For 2025, those thresholds start at $106,000 for individuals and $212,000 for married couples filing jointly. What makes this particularly challenging is the 2-year look-back period. Your 2025 Medicare premiums are based on your 2023 income. If you had a one-time spike in income that year, perhaps from selling a property or taking a large retirement account distribution, you're paying elevated premiums now, even if your current income is much lower. You can appeal these adjustments if you've experienced a life-changing event like retirement, divorce, or loss of a spouse, but you need to understand the process and provide documentation. The purchasing power of your Social Security benefit matters more than the nominal dollar amount, and this is where long-term thinking becomes essential. A 2.5% COLA sounds reasonable until you compare it to actual inflation in the categories where you spend most of your money. Housing costs, particularly for those renting or paying property taxes, and homeowners insurance have been rising faster than 2.5% in most markets. Prescription drug costs, even with Medicare Part D coverage, continue climbing. Food prices, especially for the dietary patterns common among older adults, have seen significant increases. This reality means you need to think about Social Security as one component of your retirement income, not the entirety of it. The beneficiaries who maintain their standard of living most successfully are those who've built multiple income streams. Perhaps you have a pension from a career in government or union work. Perhaps you've accumulated savings in IRAs or 401ks. Perhaps you own rental property or have dividend-paying investments. Perhaps you've developed a part-time consulting practice or small business that generates income without requiring full-time work. The conversation about Social Security solvency can feel abstract until you consider what it means for your personal situation. If you're in your 70s or 80s now, you'll almost certainly receive your full scheduled benefits for the remainder of your life. The trust fund has sufficient reserves to pay full benefits through 2034, and any reforms will likely protect those already deep into retirement. If you're in your 60s, you're in a transition zone where some changes might affect you, but dramatic reductions remain politically unlikely. If you're in your 50s or younger, you should be prepared for a Social Security system that looks different from what exists today. This doesn't mean Social Security will disappear. The political commitment to the program runs extraordinarily deep, and the payroll taxes that fund it continue generating substantial revenue. What it does mean is that younger beneficiaries might face higher taxation on benefits, later full retirement ages, or benefit calculations that replace a smaller percentage of pre-retirement earnings. Planning for these possibilities now, while you still have time to adjust, is simply prudent risk management. Your February payment represents more than just another deposit. It represents a recalibrated baseline for your guaranteed income, a reflection of the inflation protection built into Social Security, and a reminder that understanding the details of this program can make an enormous difference in your financial security. The 2.5% increase is permanent, it compounds into all future increases, and it provides a foundation that you can build on with smart claiming strategies, careful tax planning, and realistic expectations about what Social Security can and cannot provide in your overall retirement income picture.